Hey, welcome back to Father and Son Investing. This is another short follow-up to talk about the quarterly refunding statement that just came out today. 2 days ago, we learned just how much money the Treasury would be borrowing during this upcoming quarter. Today, we learn what that looks like in terms of bills, notes, and bonds. So here we go, May 1st. This is always from Josh Frost, and we'll see that it says here the Treasury is going to be offering $125 billion of Treasury securities to refund approximately $107.8 billion. Do the math there, and what you see is that the government is only going to get $17.2 billion actually out of this $125 billion to spend. Think about that for a minute. They're going to auction off $125 billion worth of treasuries to get $17.2 billion to actually borrow. All the rest is going to pay back what was previously borrowed. We'll take a quick look at the breakdown because I have some exciting news to share with you about a new Treasury bill. So let's talk about this. We're going to see that what they're doing is holding these pretty much steady here, again skewing it towards the lower end. So record number here on the 5-year, this 70 billion auction per month. Yeah, that's record highs. We're going to see the 2 and 3-year Treasury is still pretty high. We'll also notice that they're holding these numbers low. These are artificially low. They're keeping them low. Why? Because they're trying to keep the yield on the 10-year Treasury note from getting too high. That 5% back in the fall of last year scared a lot of people. The Treasury responded by decreasing the number of 10-year Treasury notes and 20-year and 30-year bonds. If these creep above 5%, what does that do? Well, not only does it increase borrowing costs for the Treasury, but it's going to increase borrowing costs for everybody. You're getting a new mortgage. That's based off the 10-year Treasury note. Plan on the mortgage interest rates going up. You're going to buy a new car. Plan on your interest rates going up. So the Treasury is artificially keeping these low right now. All right, this is the exciting news I want to talk about. Introduction of the 6-week bill benchmark. In the past, the Treasury has used what's called a cash management bill, CMB, and frequently those are going to be in the 6-week range. We'll do that often enough, and the Treasury and Borrowing Advisory Committee just went ahead and recommended that they make this a regular issuance. So there will be a 6-week Treasury bill showing up in Treasury Direct and in whichever brokerage you might want to buy your Treasury bills through. After reading through the most recent Treasury Borrowing Advisory Committee minutes, they also indicate that part of the reason for doing this has to do with money market funds. The money market funds seem to really like this 6-week cash management bill, and they've actually managed to increase some of the longevity of the holdings for those money market funds. Now, there is one more bit of news here that I want to share with you from this report to the Secretary of the Treasury from that Treasury Borrowing Advisory Committee. Let me scroll. It's this paragraph here, which they call the Blue Sky Investigation. This is really looking into possible other products for the Treasury in the future, trying to entice more people to buy. In fact, when I read through the minutes, I could see that for 2025, that Treasury Borrowing Advisory Committee is recommending that the Treasury is going to be needing to borrow even more money than they currently are. So how are they going to try to get these new investors in here or continue to get investors to invest with the Treasury? Well, there are a couple of ideas here. Here's one that they've done in the past, Treasury callable bonds. If you're not familiar with a callable bond, that just means that they might give you a high rate, and if interest rates go down, they can always essentially buy that bond back from you and reissue it at a lower yield to you or someone else. Here's another idea presented by the Treasury Borrowing Advisory Committee, the green bond market. What is a green bond? Well, it's what you might think. It has to do with being environmentally friendly, meaning the Treasury might sell these bonds but only use the proceeds for green projects. What else did they discuss? Well, they talked about some existing products, the 1-year and longer dated floating rate notes, and a 3-year TIPS benchmark. Also, maybe adding some ultra long-ended issuances. Could there be a 50-year bond or a 100-year bond? And then another instrument that they already have, floating rate notes, and linking that to the Treasury note or bond yields. How has the bond market responded to all of this information? Well, the 10-year Treasury note you can see here has declined, as have many of the others. There's the 30-year bond on a decline. There's the 7-year note on a decline. When we look at Treasury bills, even the 1-year Treasury bill has decreased a little bit. Now, this taping, this recording has been done just prior to when the Fed is going to make its announcement later this afternoon. We may see the bond market take an uptick in yields after Jerome Powell makes his announcement. I'll do my monthly Treasury bill, note, and bond update tomorrow after all of that information has come in. I hope this was useful for you. If it was, please give us a thumbs up. And until next time, enjoy your investing.